the 2008 financial crisis as a lemon problem for my final project. So I kind of want to just start off by talking about kind of how I got to the 2008 financial crisis. So originally I was going to do kind of three sections with Bitcoin and the Luna crash. Why I ended up choosing not to do this is Bitcoin didn't really fit the lemons model. It's kind of more of a signaling game, but this signaling honestly was pretty weak when I looked into it. A lot of the most recent investors, kind of the signal, because what I was looking at was how it's a signal that is of a higher quality and got people to invest in it compared to like kind of meme coins and other like low quality cryptocurrencies. How it separated itself into a high quality currency, and I really couldn't find. The majority of what I found for recent investors was that it had value and that it had gone up recently. Is why they thought it was kind of a good coin and that it would continue to go up, was just based off its recent success in years. And there wasn't a lot of substance to why it was viewed the way it was. Now there was some going back to kind of beginnings and why people initially started getting into it, and it did have value behind it. And there was some stuff about how different companies adopted it and widespread use and that type of thing. But overall, I just didn't think it was. It didn't fit the lemons market, and it overall just wasn't that interesting to look into. The Luna crash, on the other hand, so what happened with that is there was it was algorithmically pegged at $1. This is different. A lot of them are pegged with fiat currencies at $1. And so the reason that crash kind of occurred is because the algorithm worked as long as people acted rationally. However, when they panic selled, it caused the system to crash. The algorithm wasn't prepared for that. It actually, when I was reading about it, reminded me very similar of kind of like a bank run before FDIC protections. Kind of acted in a similar way. But again, it did not fit the lemons problem, and it didn't. It wasn't as much information about as I thought there was going to be, which is why I ended up going with the 2008 financial crisis. One, I think it's just an interesting topic in general, as it's the only financial crisis that's gone during my lifetime. Well, other than you count the COVID pandemic, but that was kind of a world crisis, it wasn't specifically financial or economic. And I just thought it was really, thought it was really interesting that you had, these major players and kind of institutions with the highest educated people working for them who did not see this coming, and that is just such a major financial crisis. That just with all the technology and the most sophisticated, supposedly best investor in the world, vast majority of them just never saw it coming. So, getting into kind of this presentation, what's going to look like as far as I'm going to discuss how the 2008 financial crisis fits into the lemons model framework. I'm going to be looking at the tipping points that led to the shift from a pooling equilibrium to a separating equilibrium. I'm going to talk about the leverage that occurred and how that amplified the effects of the crash. I'm going to discuss kind of the end results and the different financial penalties that happened because of the crash, and then talk about how game theory kind of explained why this happened when it did, and the major tipping points that kind of go into that. I think Keynes has a great quote on this. The markets can remain irrational longer than investors can be solvent. Even if investors know that something mispriced, it doesn't matter unless they can figure out when that's going to happen. That's the only way they can actually profit from it. So I think that's a really interesting aspect of the 2008 financial crisis, was looking at why it happened when it did. So I will be going in depth on that as well. So kind of getting to the background, kind of before the crisis. So what are mortgage-backed securities and CDOs? I'm not going to go too far into this, but it's essentially just bundles of thousands of mortgages. Each one of these mortgages has their own individual potential defaulting, and then when bundled together, they have a new cumulative chance of defaulting, which is usually perceived a lot lower than an individual mortgage, depending on the quality, of course, of the mortgage. Apologies, I am a little bit sick, which has actually why I waited this day, as I was hoping I'd get a little bit better before I had to talk. But kind of the best my voice has been, as yesterday I tried talking, I wasn't even like the mic wouldn't even pick up my voice, and half of it was like he couldn't even understand it, so was unintelligible. So we're just gonna push through it here. Another big thing, important aspect that was going on before the crisis was that home prices had continued to rise for many years, and there was this belief among investors that they would continue to rise no matter what. Rating agencies during this time period were assigning AAA more ratings to risky securities. This caused a lot of this causes a lot of lower quality securities to be rated as AAA, which would become a major issue later on. At the same time that these credit rating agencies were giving kind of subpar securities high ratings, underwriting standards like subprime lending, stated income loans, adjustable rate mortgages, ninja loans became very widespread, and the investors did not really fully understand how dramatically this loan quality deteriorated. This will be a major point kind of moving forward and looking at it as Lemon's problem. So just a little bit of overview of the Lemon problem. Sellers know a lot more about the asset quality than the buyers. This can, in some sense, create an adverse selection. If the sellers cannot send a signal to the buyers that their product is of a higher quality, or that they're all one certain quality, then a pooling equilibrium is formed. This is kind of what happened. The vast majority of securities were viewed as a high quality kind of asset, and so it sort of led to a pooling equilibrium at a high rate. And so one of the biggest issues with making the 2008 financial crisis fit into the kind of Lemon's theory, the Lemon's problem, is Lemon's problems are typically either have a good or bad asset. However, loans are really on a spectrum, and then therefore the mortgages, the securities themselves are on a spectrum. And so what I did to kind of account for this was create a continuous variable called Q. Going forward, I'll talk about how Q is a little bit androgynous and hard to actually measure. But so Q represents the proportion of high quality loans, and then FQ describes its distribution among the securities. And so this enables to kind of account for the spectrum. Zero for this variable, I did 0 is incredibly poor loans, like subprime, ninja loans, those type of things, versus 1 is the absolute highest quality, very low risk, high return on investment, very low chance of defaulting type of loans. This changes the expected value formula to a integral 0-1 VQ FQ DQ, where VQ kind of declines at a non-linear rate as the default correlations rise. That's because a lot of the low quality defaults actually caused a higher loss as they had more minimums put down on those mortgages, which was pretty interesting. And during this time period, there's a big difference between the true loan quality that was occurring and what investors believed the loan quality to be. And so throughout this time, they're kind of updating their beliefs on what Q actually is and what investors believe it to be. So kind of look at the pooling equilibrium before the crisis. Investors believe Q to be above a 0.7, and so kind of by the way, 0.7 to 1 is very good. 0.4 to 0.7 medium, 0 to 0.3 is low quality. This was really based off what I talked about earlier with the historical home prices constantly going up, price trends, AAA ratings being given out. These are major factors in this. Sellers had I had much more knowledge of the actual value of Q. As they understood that the underwriting was deteriorating, they had more access to the loans as they were creating them and knew there was lower level packages being put out. They also knew that the people working for mortgage securities and a lot of these banks, the type of loans that were given out and the kind of lax standards that had been forming over the years. Buyers didn't have really access to loan level data, or if they did, they weren't paying attention to it. And despite this kind of mass heterogeneity In the market, all securities were priced at a high level. So here's kind of some of the early indicators of a falling loan quality that we saw in the market were there were sellers throughout the paper, but kind of decreased value of Q, where like the subprime delinquencies increasing from 10% to like 15% in 2005, 2006. We saw some prime and alt-A delinquencies. They increased, which before this, these were viewed as very relatively, sorry, um, very safe loans. Um, and then also loss severity projections jumped up 15 to 20%. Um, sorry. This was a sharp increase, but markets in general largely ignored these warnings and these warning signs because the pooling equilibrium was still supported by ratings, by strong ratings from credit rating agencies and the outdated assumptions that investors believed in. So these were not taken as seriously as they should have been. So one of the major signals that occurred during the crash that really got people's attention were the credit rating downgrades. This was done by the ABX index. There was 10 to 11,000 mortgage-backed securities and CDO tranches that were downgraded between 2007 and 2008. A lot of the AAA securities, they weren't. It's not like these were just falling by AAA by one notch. They were falling 2 to 3 notches. Some of them would get downgraded to the point where they weren't uh, even valuable to investors. Um, and with this, investors uh, really lost their trust in the certification system. They made them it kind of forced investors to realize that they could not rely on the rating system to distinguish between high quality and low quality securities. And so, since like buyers did not have this trust, they know the signal whether the securities were high or low quality. They kind of backed away from the market altogether. Um, and because backed away from the market altogether because since they couldn't tell the difference between high and low quality, they kind of had to assume that there was lower quality, which would mean that um, they would only offer a lower price. Sellers of high quality aren't going to accept this lower price, so then there's only bad in the market. So then buyers / investors only have a choice of either buying a low quality, high risk security for a low price or just exiting the market altogether and putting their money into a different system. Sorry. So one of the major factors in the severity of this crash was how leverage made several major was an extremely high leverage and system fragility that occurred during it. Some of the major banks were operating at a leverage ratio of 30 to 1. This meant that even the tiniest decline in asset values could wipe out their equity. And so it kind of this meant that like as prices fell, banks faced margin calls and were forced to sell assets into weakening markets. Also during this time, repo lenders raised their haircuts from near zero to as high as 25%. This restricted the ability to finance mortgage-backed securities, which was a major issue. Credit default swaps during the time spread soared, which kind of signaled the fear of insolvency, and this interaction between these kind of complete interaction made the crisis far more severe of an event than would have been. It's why it became kind of a global financial crisis and had such a major impact. Then if these things were not happening during this time, it could have been a lot smaller of an issue than it ended up being. So kind of moving into kind of the sequence of tipping points that kind of changed the pooling equilibrium to a separating. There are several kind of high profile events that accelerated this transition. So we have the HSBC announced that over 10 billion in subprime losses in early 2007 And then New Century Financial, which was a major subprime lender, collapsed shortly after this. This collapse really kind of exposed kind of the severe underwriting that was going during this time. Um, the ABX index continued falling, making the loan deterioration very difficult for investors to ignore when they're kind of evaluating what they think Q should be and what they think it is in the market. Bear Stearns hedge fund collapse, which really they were a very sophisticated investor in the market, and so their collapse really showed, along with really showed how deeply embedded the losses were into this financial system. The Lehman Brothers bankruptcy was another major thing that happened. This happened in September of 2008. That was kind of the final tipping point. After this, there's a kind of massive global freeze. The federal government had to institute several programs. I'll try to bail them out. Kind of each of these events really increased the doubts that any investor had about the quality of mortgage-backed securities and lowered their perceived value of Q. And so kind of going into looking at the shift to the separating equilibrium, as the confidence kind of completely collapsed from the tipping points I just mentioned, investors began to demand proof of quality before purchasing any securities. But because the mortgage pools were very opaque and there wasn't a lot of verification, there weren't reliable methods already established. This was very difficult without a lot of reform happening in the industry. This led to private label mortgage-backed securities issuance falling from over 1.1 trillion in 2006 to almost zero after 2008. Only government-guaranteed securities that had clear backing kind of continued to trade. People were still willing to buy because they were kind of guaranteed as being safe to investors, and they thought that this was a very safe and high-quality investment for them to have. Which does with this kind of transition to separating income does fit what a lending model would predict. Since buyers were unable to distinguish quality, the trade began to collapse. Investors and buyers essentially went elsewhere into other markets. And so after this switch to a kind of separating equilibrium and a market freeze and the severe loss, there's a lot of significant institutional losses and systemic damage. Institutional losses mounted very quickly. Bates wrote down over 500 billion in mortgage-backed related assets, and the IMF ultimately estimated global losses near 1.5 trillion. AIG required an $85 billion bailout due to collateral calls on its credit default swaps. The asset-backed commercial paper market collapsed. This really hurt short-term funding. Bid-ask spreads during this time widened dramatically. Even for like senior tranches, which just showed how liquid the market had become. These kind of systemic effects were not simply financial. They really reflect like almost a complete like market breakdown in the trust of asset quality. And so, kind of why Lemon's theory explains this crisis. The crisis had a severe asymmetric information that prevented accurate pricing. This is a key aspect of Lemon's problem. The market participants had kind of misaligned incentives that allowed low quality assets to be packaged with high quality ones, creating a pooling equilibrium. Essentially, the sellers were able to make all good and bad medium qualities look high quality. High quality mortgage securities were unable to signal to buyers that they were a higher quality and deserved a higher price. And then as typical, once expectations were shifted and there was shown to be a difference in the value of a good versus bad asset, and they're actually significantly lower, and that the pool of assets was actually of lower quality. This completely shifted to a separating equilibrium with good and bad mortgage-backed securities, and the price, with investors realizing that it wasn't all just high quality, that there was good, bad, and medium, and with this happening, there being a significantly higher proportion of now believed to be um, lower quality securities, investors were calculating new expected value, which was much lower than high quality sellers weren't trying to sell, and they completely lost confidence. And buyers would only offer extremely low amounts. High quality sellers weren't willing to sell for that, which then led to minimal sales happening unless they were to take very risky investment, or buyers exiting the market, and kind of a complete freeze in this market, which we kind of saw with the huge drawdowns. A couple broader lessons kind of learned from this crisis as a whole are just transparency and proper incentives are crucial for financial stability. Um, Without clear information about asset quality, markets cannot function efficiently. Um, Having incentive structures that are valuable and accurate are very important, as they really do matter. Rating agencies, originators, and securitizers all faced incentives that encouraged misreporting or misclassification of an asset as higher than what it was, which led to misclassification of risk. The third is that the major thing that we learned from this is that leverage really amplifies the fragility of a market. A small shock can cause a system-wide crash when institutions are highly leveraged. And these were kind of the major explanations for kind of what the global applications of this crisis are. And so, kind of in conclusion, the 2008 crisis can be seen as a lemons problem operating on a massive scale. The loan quality deteriorated long before investors, aka buyers, ever realized it. Investors during this crisis relied on flawed certification systems. Um, Asymmetric information kept pulling equilibrium price. Once that broke, the market transitioned into a separating equilibrium that was marked by extreme illiquidity and led to an institutional collapse. The game theoretic kind of perspective on the 2008 crisis helps explain not just the crisis itself, but why it unfolded so suddenly, and why it occurred in the exact time frame it did, and what the different aspects of those tipping points and what different tipping points caused the crisis to form. Why it happened in 2008 was like the high defaults and those different prime and all mortgages increasing defaults, and why that occurred then versus 2010, 2011, where those defaults happening in those years. So I think Game Theory really did a good job of helping explain why that shift happened and why that effect of that shift happening was so drastic at that time. Overall, this was a really interesting kind of crisis to research and investigate, and it was something I really enjoyed doing.